Welcome to CFRA Thematic Insights, where we explore the market trends and investment themes shaping tomorrow's opportunities. I'm Alex Fasciano, and today I'll be discussing potential early signs of a pricing tailwind for U.S. hotels related to the 2026 FIFA World Cup. The World Cup features 48 countries with a total of 104 matches across the United States, Canada, and Mexico, of which 78 will be played in the United States. 10 of the 11 host cities are within the top 25 U.S. hotel markets, with Kansas City being the outlier. The 2026 World Cup is expected to attract 1.2 million international visitors to the United States, generating an estimated $6.4 billion in tourism spending. However, Forbes reported the economic boost and hotel demand has been lower than initially forecasted due to high travel costs, visa friction, and the strength of the U.S. dollar. The American Hotel and Lodging Association also reported that many host cities are experiencing softer than expected demand, noting booking windows have shortened as fans wait to finalize tickets and travel plans. We thought it was important to shed light on what the incoming data suggests about occupancy, pricing, and RevPAR trends. As shown on the slide and highlighted in blue, host markets were more consistently represented among the strongest ADR growth markets. In our view, the divergence between host city and non-host city ADR performance is consistent with hotels responding to anticipated demand associated with early World Cup activity through higher room rates. Notably, the one non-host city within the top 10, Chicago, hosted an international friendly match between the U.S. men's national team and Germany on June 6th. Lastly, ADR growth is ranging between the low double digits and as much as 20% among the top 10 ADR growth markets, a very strong start to the summer travel season for hotels, in our view. On this slide, we'll look at the comparable period last year in 2025, which, in contrast, host market pricing trends were less differentiated. Host cities accounted for 4 of the top 10 strongest ADR growth markets. The less pronounced dispersion in 2025 suggests that performance this year represents a meaningful departure from prior year trends. Notably, some host cities were lowering room rates at this time last year. The similarity between average and median growth rates in 2026 suggests host market pricing strength was broadly distributed rather than driven by a small number of gateway markets, such as New York City, Miami, and Los Angeles. To determine whether the outperformance was fueled by a few large gateway markets or reflected broader pricing strength across cities, we compared average and median ADR growth among host and non-host markets. Average ADR growth across host markets reached 14% month to date in June 2026, nearly 3 times the 5% increase observed in non-host markets. Median ADR growth exhibited a similar pattern, increasing 13.3% in host markets versus 5.3% in non-host markets. By comparison, ADR trends in the comparable period of June 2025 were nearly indistinguishable between the two groups, with average ADR growth of 1.9% in host markets and 0.4% in non-host markets. In our view, this suggests pricing strength was broad-based rather than driven by typical pricing strength among gateway cities and could reflect an emerging pricing tailwind from the World Cup. Higher hotel rates, not occupancy, are driving RevPAR growth in host cities. In our view, this suggests pricing has emerged as the primary mechanism through which hotels are capturing incremental demand. The divergence between ADR trends is consistent with the early stages of event-driven demand where operators seek to monetize higher anticipated travel volumes through pricing before occupancy trends fully materialize. Month to date in June 2026, RevPAR growth was 14.8% among host cities, compared to 8.7% among non-host cities. Consistent with reports from the American Hotel and Lodging Association, occupancy growth may be lower than initially expected, with non-host markets actually outperforming host markets. While this may provide evidence that demand has not materialized as initially expected, pricing tailwinds may be enough to drive better RevPAR growth among host cities. More broadly, we have a positive fundamental outlook on the sub-industry given resilient travel demand trends and asset-light models that protect margins. While exposure differs by brand, stronger pricing trends across major urban and gateway markets should represent a modest tailwind for Marriott, Hilton, and Hyatt. We believe Marriott's broad upper upscale footprint, Hilton's large U.S. room base, and Hyatt's concentration in gateway and luxury markets position each to benefit from stronger ADR trends should current momentum persist. In our view, Marriott provides the best risk-reward setup when also factoring in valuation. With that, thank you. And for more in-depth thematic research and market analysis from our team of experts, visit CFRAresearch.com. The following are additional disclosures and contact information for your records.